really wish I was out there seeing all of you in person. I recognize a lot of the names on the participant list, and I just wish I was there with you. Although the last time I was out there, Crystal basically holed me up in a hotel for 4 days over a weekend in your hurricane, and we all laughed about that. But anyway, there's what it is. So let me tell you about the day. First of all, I did this same webinar for a Century 21 company in Indiana this morning. It went over really well. I just put this together. I always try to give my best material, and you're going to see things you've never seen from me before. But part of this I'm going to be talking about at the end, the PPP forgiveness process, although that's not clearly a big part of this. I really want to make you aware, everybody, of what you need to be thinking about in terms of 2020 and 2021, as financially, these may be different years than you've experienced in the last couple of years. And then to boot, we have a recent presidential election, and we need to talk about some of the thought processes that financial advisors are going through right now. I'm going to review, the big vehicle write-offs, the heavy SUV and things like that. So Aquino, I hope you're on this phone call, listen to that as well. And I've already had questions about that from people before we even started. My material will take me at least an hour, everybody. This morning it took about an hour and 5 minutes. And then I told Crystal and Patrick that I'd be more happy to spend another 30, 45 minutes. If you've all got the time, I've got the time. But this is really a good hour and a half of material that you really don't want to miss. So there's my background, everybody. I don't look like that anymore, but that's what 130 days a year on the road does to you. And look at my picture now live. All right. So first of all, tax and financial planning moves. Remember, you get my entire PowerPoint and you get the recorded session too. So the first thing, I want you to consider putting yourself into one of three baskets, income baskets for 2020 and 2021. And then consider the following and talk to your accountant and financial advisor. And it goes without saying, everybody, that you need a good CPA or enrolled agent that does other realtors' returns as well and understands the business of real estate. So the first segment I want to talk about is, not everybody in this country, a lot of realtors, because of the hot market and the fact that it's a seller's market, the problem is inventory. All over the country, the problem is inventory. But if you put a house on the market in this market right here where I live in the Midwest, and this price is even reasonably close to what it's really worth, it's gone, everybody. I'm talking about in a couple of days, if not less. But not everyone is doing well. For speaking, we're doing great, everybody, but not all realtors are doing well either. So what if your business or wages have suffered a major downturn? Then think about this. You want to use the graduated individual tax rates. And let me tell you what, you got to keep in mind this. We have amassed so much of a deficit in the last several years, and then exacerbated by the pandemic, the government money that's been put into the economy. How we pay that back, in my opinion, is only going to come from one thing, everyone. So we're going to have higher rates down the road, and I don't see any way around it. And I don't care who the president is, what party's in the office, everyone, we got higher taxes coming down the line. So currently, though, take advantage of IRA or pension distributions. And I'm going to show you a new CARES Act rule that allows you to access a lot of your retirement plan money with no penalty and literally no tax if you do it right. So that's for people having a hard time this year. So obviously you want to defer deductions, you want to take slower depreciation on your purchases this year. But if you're having a down year, everybody, this is not the year to load up on equipment and things like that. And yeah, I still talk with my hands, I can't help it, all right? You might want to consider converting an IRA to a Roth IRA. Why? Because everyone, when you convert an IRA to a Roth IRA, you pay tax on that conversion. But if your other income is down, everyone, then that tax on that conversion of an IRA to a Roth IRA will be down as well. No need to plan for that 20% qualified business income deduction that I've been talking about in all the RRC webinars for the last 2 or 3 years. And that deduction, that 20% deduction of your profits, maybe the last year we get it this year based on the elections. Take advantage of changes in the tax law with respect to net operating loss carrybacks. So if you have a really bad year and your business ended up being a loss, everybody, in the brackets, all right? Literally, you need to talk to your accountant, but you can carry that back 5 years. So 2020 can go back 5 years. 2018 can go back 5 years. 2019 can go back 5 years. And you can offset the taxes you paid on that same amount of income 5 years ago. So this is to put money into your hands right now. Defer retirement plan contribution, everybody. If you're having a bad year, this is not the year to plan on putting money into a SEP IRA or a 401k for yourself or your employees. Now, nobody's talking about this, but if you have children in college, everyone, go with me on this. If you have children in college, you may have paid for some of that tuition with 529 plan money, which means the money comes out and is tax-free. You put the money in and it grows tax-free, and you spend it on education, it's tax-free earnings. Well, what's happened across the country with the pandemic, a lot of the schools have gone online, everyone, and many of them have refunded previously paid tuition because going online is cheaper than having the kids there in the dorms, in classrooms, things like that. So if you got a refund of 529 spent money, then you have a certain period of time to roll that back into your 529. Because if you keep that money without putting it back into 529, now it has a taxable consequence. And that's an inadvertent issue, but you don't want it to happen. Now, what else? The next and last slide on those of you that are having a bad year. There's a little known point called a qualified health savings account funding distribution. And this is where literally you can take money out of your IRA tax-free and roll it into your health savings account to pay for what your insurance won't pay for. It's a one-time in your life decision. It has limits, everyone, but it's an opportunity to fund a health savings account if you want to. Take a real good look at your withholding or your estimated tax, especially your estimated tax. Your accountant probably did your return before the full effect of the pandemic was known. And they may have had you estimate your taxes based on your 2019 profit. And everyone is that 2019 profit is not going to stay and be the same or more in 2020. You may want to cut down on your third quarter estimated tax payment, which has already been due September 15th, but the fourth quarter is due January 15th. Why give them money when you're going to get it back anyway? Second from the last bullet on this slide. If you have been making good money, everyone, you've been so many years away from what is called the earned income credit. This is a low income tax credit, refundable credit for people with lower levels of income with children at home. So if your income is way down in 2020, you may find yourself qualifying for this credit. Probably not, but you never know. So if it comes up in your tax return, or at least talk to your accountant, have they considered the earned income credit? And you're going to see this on all my slides. If you've taken out a PPP loan, you be prepared for the PPP forgiveness process, which I'm going to take you through at the end of this presentation. But I'm fairly sure that you're not going to have to pay back any of your PPP loan. And we'll talk about that when we get there in my presentation. Now, for those of you that are having a year consistent with prior years, just one slide here, all right? Business as usual, take a look at your estimated tax payments, make sure you're on track with that. Tax liability should remain about the same as it was in 19 because we've had no substantive changes. Consider conversion of some of your tax-deferred retirement accounts. And you've all heard me talk about SEP IRAs and 401ks for the self-employed every time I've come out there. And consider taking some of that tax-deferred money and rolling it into a Roth IRA. Again, everybody, because tax rates later down the road, tax rates now. You may find 179, the first year expensing election, and bonus depreciation. And that's how you're going to write off that heavy vehicle. But the 179, the first year expensing election, and bonus depreciation are just gorgeous tax write-offs if you want to reduce your tax liabilities as much as possible. Consider employing family members, especially minors, in your business, something I've talked about for years. Establish and contribute to your tax deductible health savings account. Again, same thing on the PPP loans. I'm going to show you how that will be forgiven at the end of the day. Now, go with me on this issue. If you're making decent money, everybody, and consistent with a year's past, and you're going to see these two slides on the next set of slides too. But if you have purchased rental property recently, or you own a large portfolio of properties, you ought to look into having a cost segregation study done. And it's all about tax savings, everyone. And it's all about taking depreciation from longer lived assets and attributing that depreciation to shorter lived assets, which gives you one heck of a nice tax write-off in the year they do the cost segregation study. And last but not least on this slide, and Hawaii has got its fair share, everyone, of qualified opportunity zones. I have a client that has already invested over $2 million in qualified opportunity zone properties in the Hawaiian Islands, and he is living there already anyway. But this is a way to create a wonderful tax deferral, meaning if you sell stocks or mutual funds or rental property at a large capital gain, you can elect to reinvest that money into qualified opportunity zone property and defer the tax until 2026. That's pretty slick, everybody. So people started doing this in 18 and 19 and now 20. So the deferral period has gone from 9 to 8 to 7, but still not having to pay the tax for 5 or 6 years is pretty sweet. Now, there's a good number of you, everyone, that are just knocking the socks off of your business. And Chris and I were talking, the speaking business, everyone, I've given, I think, 4 live seminars since March 15th of 2020. But almost every one of my, and not everyone, but the majority of my scheduled seminars from March 16th through about the last 3 weeks went to webinars, probably about 75% of them, and the other 25% rescheduled into 2021. So, you know, there's a lot of you that are doing really, really well this year. And now, what should your tax considerations be? So obviously the top bullet, maximize contributions to your retirement account, SEP IRAs, 401ks, defined benefit plans, etc. Consider conversion of some amount of tax-deferred retirement accounts into a Roth IRA, again, betting on tax rates being higher down the road. If you've inherited property, everyone, this might be the time to consider selling that, because when you inherit property, you get a stepped up basis up to fair market value as of the date of the decedent's death. And that becomes your basis for future sales. So if that's happened in the last couple of years, you may very well have very little tax to pay if you sell that property. Gifting to heirs. Everyone, if you're having a great year, and Kay and I, my wife, are, and she's doing fine, everybody. I left just as we were getting started to do this, to go do some shopping. But we're meeting with our attorneys right now because we're doing some serious gifting to my 2 girls and their husbands, Kay's 2 boys and their wives, all right, and then 10 grandchildren, and we got to get this done by December 31st. So gifting to heirs, everyone, will be good for several reasons. Number one, reduces your estate, and I'll talk about that in a little while. And furthermore, it helps these kids in the pandemic, because I guarantee you that between all these people in our extended family, there are those that haven't worked since March 15th or 20th, whatever the case may be, and the money is obviously helpful. So employ your family members, especially minors in your business. You've heard me talk about this for years, everyone, and that is, you know, you're making good money. You hire your 17-year-old child or grandchild, whatever, to work in your business as an employee. The first $12,400 that a 17-year-old kid makes, everybody's tax-free to them, yet it's deductible by you. That's the increased standard deduction. So it is more relevant now than it ever has been before. Now look at the last bullet, and I really want you to, this next bullet, I'm sorry. Use the 1031 like-kind exchange for real estate while they're still allowed, all right? And I'm just telling you, the articles I've read, the 1031 real estate exchange could be on the chopping block under federal tax law next year. So I'm going to say it 3 times. Invest in our PAC, Invest in our pack. Invest in our pack, everybody. That organization and NAR fights for homeowners, property owners, investors in real estate, and realtors, everyone. So one more time, invest in our pack. And then again, use 179 and bonus, which I'm going to cover in more detail later, to reduce your marginal rates. And then you might want to consider, but you're going to talk to not your accountant, you're not going to talk to me about this, you're going to talk to your attorney, who's going to be an estate and gift tax planning attorney. Should you consider establishing and contributing to a charitable remainder trust? Food for thought. Now, the last slide on planning, everybody, for 2021. For those of you having a banner year, gift appreciated stock, if old enough, 70 and a half or older, consider, qualified charitable distributions directly to the charity of your choice. Consider purchasing municipal bonds because they're tax-free at the federal return. Donate to a donor-advised fund. Everybody, look at me just for a second on this. A donor-advised fund is where you make a substantial contribution, $10,000, $15,000, $20,000. All right. You get to take the deduction when you invest the money in your donor-advised fund. And most mutual fund families have a donor-advised fund. Then you get to tell the fund over the next couple of years how to divvy that money out to the charities of your choice. So you get the deduction when you put the money into your donor-advised fund, and then you have 2 or 3 years to tell them how to invest the money or how to spend it on the charitable causes you want them to spend it on. Next bullet, establish and contribute to a health savings account. Again, the same comment on the PPP. I'll talk about that later. And then the last 2 comments, everyone, are the same I made to the people having the same kind of year, and that is consider the cost segregation study and the investment of your capital gains into qualified opportunity zone properties. Now, I want to show you an email, and a lot of us go back, everybody, to Howard Brinton days, all right? So Joanna Fox and I met each other in Howard Brinton events. I've seen a number of you over the years, and unfortunately, we lost Howard a number of years ago. But in the last month, I received this from one of his stars that I've known for years, and I've taken all the names and the locations out of this so I don't put anybody on the spot. But over 20 years ago, I mean, they were making serious money, everyone. And I said, don't mess around with SEP IRAs and 401ks and things like that. Go to the big dog, go to the defined benefit plan. And there are people on this webinar, and I know this for a fact, have defined benefit plans. And they've listened to me over the years, and they've listened to their financial advisors, everybody, because you can put in way more money and you can deduct way more money, but you got to have the money to do it with. And they're still around and they're still good. All right. So here's the email I got. Hi, Chris. Hope you and Kay are doing well in these times. Fortunately for us, we are in Eastern State, everybody, which has been safe. The wife and I want to thank you personally for the advice you gave us over 20 years ago at Howard Brinton events to open a defined benefit plan. We contributed to it every year until 2018 and terminated the plan in late 19 when both the wife and I capped out on the maximum allowed amount. We rolled $4.2 million to our IRA accounts and also funded their employees $404,000. The last year, our gain on the plan assets was over $700,000, which was what ultimately put us over the top. Was it easy? No. There were times it was a burden, like in the financial crisis of 08 and 09, but we kept on with it and we were happy that we did. One other added benefit was our timing was perfect for once. We hit the top of the market when we cashed out of the plan assets and then sat on it through the COVID downturn. Thank you so much for this tip. It worked out perfectly for us. Wishing you continued success. Blah, 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 blah. And I sent them just a quick email back. Thank you for the kind words. We love lobster. All right. They're on the East Coast, obviously. And a week later, everybody, a case of lobster tails came in. So that was pretty cool. All right. Now, tax changes, everybody, tax changes. Many of you, like Kay and I, my wife, no longer can itemize our federal tax deduction. I was talking to a gentleman before we even started this webinar with Crystal a little bit while ago about this very point. In fact, only about 10% to 15% of all 1040s filed still itemize their deductions. Now, everybody, Hawaii is going to be a large representation of that 10%, where I live in the Midwest, are not well represented there because simply our home values are not what they are as in Hawaii. Therefore, your mortgages are higher, everyone. So you're going to have a higher percentage of people claiming itemized deductions than we would in normal real estate markets around the country. So for those of you that cannot itemize, you get a lousy little $300 charitable contribution deduction on the front page of your return, which is better than a stick in the eye. And that $300 is for a couple, 300, or a single person, 300. So a married couple does not get 600 bucks. But those of you that do itemize and claim your Hawaii state income tax, your real estate taxes on your principal residence and a second home, your mortgage interest, well, you can also take your charitable contributions so you don't get the 300 bucks. So for those of you that are heavy contributors and who can itemize, there are higher contribution limits on the deduction. For example, in 19, you could only deduct up to 60% of your adjusted gross income if you gave that much. In 2020, they raised it to $100,000. I'm sorry, 100% of your adjusted gross income. So let me give you an example. An 85-year-old woman, all right, single, very well-to-do, has $100,000 of pension and IRA income. And she wants to give as much as she can deduct every year. So in 2019, all she could give was $60,000 and she could deduct that. Now, if she gave 80 in 19, she would deduct 60 because of the 60% rule and then carry over the other 20 to 2020 to see if she could deduct it then. Well, in 2020, assume the same numbers, everyone. If she has 100,000 of adjusted gross income and she contributes 80,000, she can deduct all 80 because they raised the 60 to 100%, and that's good. And then finally, everyone, look at the last bullet on this page. There was a proposal in DC early in 2020, and nothing's happened to this. Nothing's come about. You never know what's still going to happen, but it hasn't happened yet. But they wanted to make meals and entertainment 100% deductible for self-employed people. So entertainment right now is 0, right? Meals are 50%, and they wanted to make that 100% deductible to help the restaurants, et cetera, et cetera. And everyone in Illinois right now, we are back on lockdown in terms of inside eating in a restaurant. It's prohibited. Outside eating with social distancing is still okay. All right. Now, other tax changes. So first of all, solar energy, everyone, is really catching on. Midwest, I've seen a lot of work on this. And a comment I'd like to make is, at least in the Midwest, and I'll lay you money, Hawaiian Islands is no different. It's hard to get building materials right now because everybody's home and they're seeing what should be done around their home and they're having jobs done. So we had a new roof put on our house just last week, everyone, a big shingle job. And we had to wait 3 months to get the shingles, the right shingles that we wanted because they were in such short supply. The same with deck materials, everybody. It's just really tough to find materials. So the same with solar energy. So the tax credit for solar energy, and this is primarily the collectors, everybody, where you set the array of collectors up and you cut into your electric bill, obviously, which would be very popular, I would think, in the Hawaiian Islands. But the federal tax credit has dropped from 30% to 26% in 2021 and drops, in 2020, and then drops another 4% to 22% in 2021. At least as it stands today, and who knows what future tax legislation might do. The second bullet, the 1099 miscellaneous for independent contractors has been changed to a 1099 non-employee compensation. So all of you will be looking at a different looking form that you get for your sponsoring broker by January 31st of 21 for 20. It'll be a 1099 NEC, not the 1099 miscellaneous. Now, look at the bold type paragraph, the third bullet down. So this is what I was alluding to earlier. Everyone, if you are having a tough financial year and you have money in IRAs, 401ks, 403bs, 457s, etc., tax deferred retirement accounts, you are allowed, because of the CARES Act, to access up to 100 grand, all right, because of COVID-19, to pay your bills with and things like that. And if you're under 59 and a half years of age, there's no 10% penalty. And then you have 3 years to pay it back if you don't want to pay tax on it. And if you don't want to pay it back, then you have 3 years to pay the tax on the money. So let's say you took 60 grand out in 2020 just because you needed to pay your bills. You would pay tax on 20 grand in 20, 20 grand in 21, 20 grand in 22, plus no 10% penalty. Or if you didn't want to pay tax on it, you have the 3 years to pay it back to your plan. And the last bullet, everybody, before I move on, is the IRS is even more concerned about virtual currency like Bitcoin, all right? And that's the big one out there, but there are 1,499 other virtual currencies. But they moved the question, are you involved in virtual currency, from a supporting schedule on the 1040 to the front page of the 1040. Big Brother is watching. Simple as that. Now, for those of you involved in commercial real estate, not residential rental, but commercial. So this would be office buildings, warehouse, restaurants, retail, everybody. But if you have a client or you yourself are involved in commercial real estate properties, we have a huge change in tax law by the CARES Act that came about as a result of the pandemic. And that big change is this. Back in 2017, when Congress enacted the Tax Cut and Jobs Act, they meant to have the leasehold improvements eligible for 15-year depreciation. That's pretty quick. But they didn't address it. So by default, the tax period to depreciate qualified leasehold improvements, now called qualified improvement property, was 39 years, which is very slow and very long, which means you have to wait a long time to write that off. Well, the CARES Act of March of this year, Congress retroactively went back to 1/1/18 and said, you can file amended returns for 18 or 19, or if you did it in 20, you can now depreciate qualified leasehold improvements over 15 years instead of 39 years. Everyone, that more than doubles the write-off every year. And the other thing is, you can file amended returns to correct those other returns you filed using 39 years. And if you want to take the whole thing off in the year you did it, like 18 or 19 or 20, you can now do that under bonus depreciation rules. So when I taught this to Tennessee about a month ago, I just went through this. Everyone didn't think many people would react to it. And a woman emailed me the next day and said she and her husband, a realtor, own commercial properties. Their tax return was at their accountant's getting ready to be prepared and finished until she heard this, and she put the brakes on having the tax return done, and it changed the complexion of their taxes totally. So you never know what's going to help a given person. Now, for those of you that are 70 and a half or older, and let me tell you what, everybody, Crystal's getting close, okay? And Crystal's a dear friend of mine, and she's probably going, ah! And you know as well as I do, she's nowhere near it. Yeah. And she's nowhere near it, you know it. And but for those of you that are 70 and a half or older, you can now make contributions to your IRAs past 70 and a half. Everybody, this is a sea change in tax law. It's a huge change. My entire career, everybody, in taxes, you could not contribute to a regular IRA after reaching age 70 and a half, but you could contribute to a Roth IRA after 70 and a half. Now you can contribute to a regular IRA for the rest of your life, everybody, 75, 85, 95, 105, whatever, all right? Then they also, look at the second bullet, they extended the date that you have to start taking money out of your IRAs by a year and a half. It used to be 70 and a half. Now it's 72, giving people more time, everyone, to accumulate money. Now, one more thing too, just so you know, for anybody that is 70 and a half or older, now 72 or older, that has taken money out of their IRA in 2020, everyone, you did not have to do it, all right? So Congress waived people being required to take their RMD in 2020. And that's pretty good, everybody, because that leaves more money in retirement accounts for later years. Now, the only other thing I want to talk about is the fourth bullet down. 529 plans, college education plans, can now be used to pay off up to $10,000 of accumulated student loans of the beneficiary and or the beneficiary's siblings. So that again is a huge change in tax law. And so many things are coming to play. Everybody, we have the CARES Act, the Secure Act, the PPP Act, the PPP Flexibility Act, all kinds of things that have happened this year. So now let's talk about strategies, all right? So first, everyone, let's talk about election-related topics. So it's now November the 10th. Tomorrow's Veterans Day, all right? Thank you for any veteran on this call. Thank you for your service and what you've done for this country. Now, the election-related topics, many higher income taxpayers are taking their capital gains in 2020, meaning they're selling what they want to sell this year, because the rhetoric they're hearing is that capital gains rates are going up as soon as they can get the law changed. All right. Now I got to go through Congress and all this good stuff, but capital gains rates could go up if the administration changes. And right now it's looking like it will. And I'm not getting into that argument. All right. 2, many expect the lower marginal tax rates that have been around since 2018 to be rolled back in 2021, everyone. And this is not criticism. I'm just telling you what I've read and heard. But President-elect Biden thinks that the Tax Cut and Jobs Act of 2017 was too generous, and he wants to roll most of those changes back. So we'll have to see. And again, if don't anybody comment about me taking political sides, because I'm not. I'm just telling you what I've read and what I've heard. Now, in the case that any of you are C corporations, the current rate of tax on C corporations is a flat rate of 21%. And it could be that that rate goes up to 28% with future legislation. Again, read and heard. So what you might want to do is you might want to talk to your accountant and consider everybody going back to an S corporation. And I've talked about that for years when I've been out in the islands. Now, what else? Now, this is a big issue, everybody. And I've had a discussion with some really high net worth friends of mine about this. So I personally believe that the current federal estate tax and exemption, which is $11,580,000 for everybody on this webinar, all right? Me, Crystal, right down the line. So for married couple, everybody, that's $23 million and something dollars, all right? But they want to drop that back to less than half, all right? And it could happen next year. So what I've been telling my friends is talk to these high net worth clients is talk to their state and gift tax attorneys. And if they're going to make gifts, they need to consider doing it by December 31st of 2020 before potentially the phase down could occur in 2021. And generally, everybody, Congress does not have a claw back where they would change the law in 21 and then claw back what you did in 20 and say you can't do that. All right. At least it's never happened before. But again, what do I know? Now, look at the second bullet, please. Remember that there is zero gift tax if you give over the annual gift tax exclusion. That's a myth out there, and I've talked about that in all my seminars out there. Because if you give over $15,000 to any one person in a given year, all you use up is part of that $11,580,000. And then finally, everybody look at the last bullet. There's a big myth out there in the public that if you give over $15,000 to any one person during the year, the sky is falling, all kinds of bad things are going to happen, all kinds of taxes. That's pure myth, everybody. It's just not the truth. So let it go. Now, 5 tax maneuvers that every one of you should consider this year. All right. Consider S corporation status versus sole proprietorship or LLC. And there are some states, everybody, that are more favored for this than others. For example, Tennessee, you cannot incorporate as a realtor, right? Well, the islands are not like that, everyone. All right, we've dealt with that before. Number 2, Hire an aggressive but legal CPA or enrolled agent for tax work, planning, etc. And I know you're in good hands if you're meeting with your accountant 2 or 3 times during the year. But if you only meet with them once, good luck with that, everyone, because now they are a reactor. They're not a planner, and that's not what you want. Number 3, you've heard this from me. Don't go overboard with tax strategies, all right? They should never occupy the first place in your mind. There are more important things about life than this. But don't let the tax tail wag the dog. So you got a perfectly great car, everyone, and it's a year or 2 old, but you've had a banner year this year, and you wanted to reduce your taxes, and you're thinking about buying a heavy SUV that you need like a hole in the head, especially when your vehicle is working right now. All right. So, just don't let the tax tail wag the dog. And we've all been guilty of this at different times, including yours truly, everyone. I haven't done it very often, but I've done it occasionally in a weak moment. Number 4, prepare or have prepared a monthly cash flow and profit or loss statement for your business and stay on top of it. You've got to know how you're doing every single month, everyone. And those of you that are doing well, I think you're more attuned to this than the people that are just kind of approaching real estate from a shotgun standpoint, where all this money is there, you pay your bills, and what's left, I don't know, but I'm having a good time. All right. You got to be more disciplined than that. And then finally, number 5, keep your expenses in line with your income, and then plan where you're going to invest the difference. So everybody, you've got to make this amount of money, whichever that is, whatever that is. But whatever that is, you've got to keep your spending to this level, everyone. And then you've got to invest the difference. I mean, I'm going to talk a little bit out of school right now, but I'm going to praise my dear friend, Crystal, everyone. Crystal Bissay, I might add. And she is going to rent out her home instead of selling it, everyone, as she and her husband are buying another house. I'm proud of Crystal. She's listened to that 204 stuff for so many years, from Carlton and Zaby and Bird and the other people, Chuck, right down the line. So it works. It really does. All right. Now, you all know the answer to this already. Entertainment, everyone. You know that entertainment expenses are gone. So you take a client to the University of Hawaii football games or the theater, everyone, or something like that. Entertainment is now zero unless they change the law. It's zero as of November the 10th of 2020 for 18 and 19 and 20. Meals are still 50%. Entertainment is zero, and promotion and advertising are 100%. So look at the last bullet, if you would. Use client appreciation events as a way around this problem, everyone. If it's advertising and promotion, it's 100%. If it's entertainment, it's zero. And one thing I would do is I would not even have an account called entertainment in your books, because if you give a number for entertainment to your accountant, it's going to end up being zero. But if it's called promotion or advertising instead, it'll never become a question. Now, I was asked if I was going to be talking about vehicles. So what happened in 18, everybody? And, I've been to the Hawaiian Islands so many times, and my good friend Wendell, God bless him, all right? My good friend Wendell Wong brought me out there when I taught a CRS celebration in Louisiana, New Orleans, many, many moons ago. And he came up and he hired me to do a celebration for you guys. And that had to be over 20 years ago, for all I know. But anyway, so for a number of years, everyone, the luxury car limit was $16,000. And that meant if you went out and spent 50 or 60 grand on an Infiniti, Mercedes, or Lexus, and used it 100% for business, hypothetically, just go with me, all right? 100%. Didn't have to, but just say 100%. And you spent 60 grand on that vehicle. The most you could depreciate in the first 5 years was $16,000, which was literally ridiculous, everyone. And for the value of the properties that you're showing in the islands, people don't want to be driven around in a Czechoslovakian or Polish Yugo, right, looking at vehicles. And I don't think you could get one of those for less than $16,000. Well, this was a real disaster for years, but Congress was very rigid about this. Well, in 1/1 of 18, with the Tax Cut and Jobs Act of 2017, look at the board, everybody, Congress almost tripled that to $47,120, meaning that if now you go out and spend in 18, 19, or 20 or 21, if you go drop 60 or 70 grand on a business vehicle, everybody, and use it 100%, and then drive it for 5 years, instead of only writing off 16,000 of depreciation in the first 5 years, you write off 47,120. Everyone, this has made the business deduction for cars a lot better than it ever was before. Now, it's still not as good as the heavy SUV or the pickup truck deduction, but at least they've come a long way in this. And excuse me, look at the last bullet, please. The heavy SUV and the pickup trucks are not subject to these limits, and that's what makes them still such a good deal. So in 2020, the standard mileage rate is 57.5 cents. I actually went down a half a cent from 2019. And in my garage, everybody, I have my Subaru Outback, which gets 30 miles to the gallon. So I most likely will claim the 57.5 cents a mile this year, but I haven't decided because I got the vehicle, ordered it in January. And then the pandemic hits, everyone. And if I'd known the pandemic was hitting, I'd never order this car, all right? Because after 7 or 8 months now, I think I've got 4,000 miles on it. Well, in a typical year, I'll put 30,000 miles on a vehicle. So anyway, this has changed a lot of things. So the standard mileage rate is 57.5 cents if you claim the standard mileage rate. Now watch. You either do this, the optional mileage rate, or you claim actual expenses. So what are examples of actual expenses? Car washes, waxes, annual licenses with the state or municipalities, taxes, repairs, maintenance, interest on the loan, oil and lube, everybody. For example, I got to take mine up for a oil change after this webinar. Fuel and depreciation. And notice how I've underlined the word depreciation. Now, everybody, I'm going to take you back real quickly. Remember what they did with cars. They tripled the amount you could write off over 5 years. And in doing so, here's what it looks like, all right? And remember, you're getting all my slides. So the automobile vehicle depreciation, if you're going to claim actual expenses, is $10,100. This is for cars, all right? If purchased and used 100% for business. And if you claim bonus depreciation is $18,100. And under the old law, everyone, when the amount was $16,000, the $10,100 was around $3,500 or $3,600, and the $18,100 was around $10,000. So things have gotten a lot better for the cars. But now let's talk about the heavy SUV or the pickup truck. And everyone, look at this if you would. So here's a Lexus, everybody, and this is whatever model this is. It's not even a real picture, everybody. It's an artist reconstruction. But you've seen this. This is the production plate that has to be on the driver's side door or door jamb. And this is what you look at. This happens to be a Chrysler vehicle, everybody, FCA. And look in the upper right-hand column where it says GVWR, gross vehicle weight rating. Every vehicle has to have this. So first you see it in European pounds, kilograms, I'm sorry. And then you see US pounds, 69.50. And everyone, that far right-hand number next to the LB better say 6001 or more, because if it says 6,000, it doesn't qualify. You have no idea how many vehicles made in the last couple of years come out exactly at 6,000 pounds. And I have no idea why they do that, everybody, because there's nothing you can do to change that. But open the door and check. If you're going to buy this vehicle, make sure, and you're looking for that big write-off, make sure that it has this kind of weight over 6,000 pounds. So what is the write-off, right? Look at this if you would. So here's a beautiful vehicle, everybody, whatever it is, Tahoe, GMC, I don't care, all right? Don't even know if you can get one for this. I don't care, it's just an example. But 60 grand is the cost. You buy it between now and Christmas, everyone, excuse me, now and December 31st, okay? You use it 100% for business. You pay 60 grand for it. You can write off 60 grand. You don't have to pay cash for it. You can finance with GM, Ford, Toyota. I don't care about it. Doesn't matter. It's just that you have title to the car, the vehicle. Now, let's look at the board if you would. And now let's say you only drove at 80% for business. Well, everybody, it'd be 48,000, 70%, 42,000, 90%, 54,000. So the heavy vehicle deduction is still with us, and the bell shines on this deduction. Trucks, same thing, everyone. Full-size pickup truck, new or used, same thing, everybody. 60 at 100,000, 100%, 90% would be 54,000, et cetera, et cetera. Now, if you've had a really good year this year and you need to replace your vehicle, everybody, well, nothing's changed here. You've got to own it. You cannot lease it to get this big first year write-off. All right. I have nothing against leasing. Everybody, friends of mine out there do lease vehicles. And if you're paying, just for example, $1,200 a month in lease fees, and you're driving that vehicle 80% for business, then you have a $960 deduction every month. That's basically 80% of the $1,200. That's how it works. All right. Now, what about to finish up the heavy vehicle? Still as good, if not slightly better than the previous years. See if any of my slides from previous tax talks for further details. Everyone, if you're RRC, I've been on the horn every year, twice a year, with Paul Dahl doing webinars for CRS. Those things are there. All right. And then look at the gray box at the bottom. Be sure to check the GVWR before buying. All right. Now, we had, Kay and I are both licensed Illinois real estate brokers. And I know this doesn't mean much to you all, everybody, with your values, but Kay closed over $1.2 million in real estate closings just in the last 7 days. All right. And those have been ongoing for about the last 2 months or so. But we had an agent, everyone, test positive, COVID positive, in the last 10 days. So our office is shut down, everyone. Nobody, no ingress, nobody gets in, right? Until that place has been spiffed up, cleaned out, everyone. But they don't want anybody up there for a period of time, and then they're going to reopen the office. But the person's doing fine. They had a few really bad days, but they're doing fine. No hospitalization, no ventilator, no nothing. But my point is this. So many of you are working from home. And if you look at me, everyone, I mean, I'm just going to do this real quickly. I'm taking my, my camera, right? And this is my dedicated office in my home. It always has been, all right? And it's the only office of Chris Bird Seminars, Inc. So I have no trouble with this. But I suspect that after the pandemic is over, some of you may be enjoying working from your home a lot more than you thought you might have. So consider the home office deduction, all right? So there's an easier way to claim it since 2013 called the IRS Safe Harbor, which is pretty cool. But look at the next slide, if you would. Here are the requirements that I've taught a dozen times in my classes in the Hawaiian Islands, and is still the law. First bullet, you must be able to prove that you use the home area designated as your home office exclusively for business and on a regular basis. Everyone, once again, you don't see any athletic equipment in this room. There's nothing but business. Look down here this is a dedicated office, a pedestal table. I'm taking you, and then here's my built-in cabinets, everybody, for this office. I went through an audit by the IRS, came out fine over probably 14 or 15 years ago. And I asked the agent point blank, what do you think of my home office? And his comment was, if this don't qualify, nothing will, all right? But then you got to use it exclusively and for business and on a regular basis. And the last bullet, you must meet the substantial use test. This test requires that you be able to prove that the home office is used the majority of the time to conduct the management and administrative tasks of running your real estate business. So clearly, if you're spending the majority of your time out of your broker's office, everybody, not your home office, forget it. But if the opposite is true, then talk to your accountant about it. Now, I'm going to hit this one very quickly. I've been on this so hard the last 3 years. This 20% deduction, everyone, is the coolest thing since sliced bread. That Congress would give us a 20% free for nothing deduction of 20% of our profits. It's been around for 18 and 19, and now it's around for 20, but I make no promises about 21 and on. I make no promises. Enjoy it while it's here. Now, also, if you own a lot of rental real estate, okay, consider the 20% on your rental real estate profits as well. And we found out in late 19 what the IRS thought about that, which is good. Now, a couple of things. I told you I'd be talking about how good 179 and bonus depreciation are. And I want you to think about all the equipment, the vehicles, the cameras, everybody, the drones, the technology equipment that you bought, the furniture, et cetera, et cetera, et cetera. Can you write off all that in the first year? Yes, if you want to. But look at the second bullet, if you would. Really, the first bullet, I'm sorry. Congress made the 179 deduction eligible to be claimed on commercial real estate properties, not the building itself, everybody, not the land, okay, but on the roofs, on the HVAC and the security systems, etc. So if you put a $400,000 roof on a commercial building, if you wanted to, you could write that whole darn thing off in the first year. That's pretty slick. Now, the second bullet, they also made those of us that own a lot of residential rental property eligible to claim in the first year the whole expense for appliances, ceiling fans, floor coverings, blinds, outside equipment like mowers, snow blowers, trailers to haul that stuff, pickup trucks to haul that stuff, etc., etc. So everybody, let me tell you what, and you've never seen me criticize the government or the IRS in all the times you've ever seen me. I will not do it, all right? First of all, the IRS does not write the laws, everybody. They're the ones stuck with enforcing the laws. And then Congress has their political motivations for passing laws. But I will tell you, since the Tax Cut and Jobs Act of 2017, since we've had the Secure Act, the CARES Act, the PPP Flexibility Act, everyone, these laws are all about putting money back in your pocket. No ifs, ands, or buts. And I don't care what party passed them, everybody. That's not what I'm saying here. I'm just saying we've enjoyed a period of lower taxes, and that's pretty sweet. Simple as that, all right? And all good things have to come to an end, but these have been good years, the last 4 or 5 years from a tax standpoint. Now, here's a chart, everybody, I give you, and I'm not going to go through it, but between 179 and bonus depreciation, you can pretty well find the write-offs that you want. Now, look at this one, if you would, because most of you don't itemize anymore, all right? That means that any charitable donation you write out of your business account, your accountant, if they know about it, will not deduct it as a business expense. Now, I know this probably riles some of you, everybody, because for years, Kay has written donations out of her S Corporation checking account. And so have I, because you had that checking account with you when you got solicited. So you wrote the check out for charitable purposes out of your business checking account, and you think the business can deduct it, and they can't, everybody. They all flow over to the 1040 to be claimed as an itemized deduction, all right? And because so many of us no longer can itemize, we just lose the deduction for charitable contributions, and it still is a good thing to do, everybody, but just don't do it because of taxes, because that probably doesn't exist. But if you want to assure yourself, that's why I'm doing this, if you want to assure yourself of a business deduction, then don't make a charitable deduction. Go to your church, your synagogue, your mosque, everybody, whatever, all right? And ask them how you can sponsor events and sponsor programs, all right? And maybe they put your name, everyone, on a big banner across the front of the church on Sunday night when they have bingo, or something like that. All right? I've seen that over my career many, many times. You've seen people sponsor ball teams, everyone, although that would not be a charitable event. Maybe to the YMCA it would be. I'm just saying on that. Okay, I'm not saying for certain, but I'm just telling you that I would consider basically a sponsorship versus an actual charitable contribution, because it's 100%, possibly better than 0%. All right. Now, retirement plan contributions, no. But I remember, everyone, the times that I've been out there teaching my 3-hour zingers on financial planning and all that good stuff. And then over lunch, we'd have a financial advisor from a local bank, and then they would blow the amounts and things like that. And you go, oh, that's not right, and all that good stuff. And I think that's cute. You were listening. But let me tell you what, you got to have a retirement plan. And you've heard me beat this into your heads every time I've been out there talking about financial planning or CRS 204. And Pat Zabi, my friend, tells the same thing. Dale Carlton says the same thing. What is your retirement plan? I have friends and clients in the Hawaiian Islands that they don't believe in SEP IRAs. They don't believe in 401ks. They believe in buying investment real estate, both of a commercial nature and a residential rental. And that's 3/4 of my wife's and my portfolio as well. So you got to have a plan, people. You got to have a plan. Make this, spend this, invest the difference. But in terms of the conventional plans, here we go with the maximum limits for 2020. You've got the IRA with a limit of 6, the simple IRA and 401k with a limit of 13.5, the 401k 19.5, and finally the defined contribution SEP is $57,000. And then everybody under the Geezer rule, all right, and she yelled at me so bad that I'm going to tell you that Crystal doesn't even qualify for this, everyone, all right? You have to be 50 years of age or older to be able to put another 1,000 into your IRA, or another 3,000 into your simple, or another 6,500 into your 401k, 403b, or 457. So everybody, if you have somebody else in your life, married or unmarried, I don't care, you got somebody else in your life, I hope you're telling them, if you plan on a future together, how much are they putting away into their retirement plans? Because you got to both dance together, everybody, on this. It's hard to dance alone and have one person save for 2 people's retirement. Now, you've all seen this chart from me for many, many years. And this is simply the current update of how much you can put into a 401k versus a SEP IRA. So look at the 3 columns, if you would. 50,000, 80,000, 220,000, trying to get to as many people as I can. There's your profit, or there's your salary from your S corporation, 50 or 80 or 220. And go to the bottom row. If you have a SEP IRA, the most you can put in is 10 to 12 on 50, 16 to 20 on 80, and 57,000 on 220, all tax deductible. Now go up 2 rows, all right? Most of you could do this already. You've been through this so many times with me. If you have the 401k, you can put in 32,000 and deduct it on 50, 39.5 and deduct it on 80, 57,000 on 220 and deduct it. Now, if you're 50 years of age or older, you can't help yourself with the bottom row there, but you can help yourself with the 401k, an extra 6,500. So 50 plus 38.5, 46,000, or 63.5. And let me tell you what, if you're making 220, everybody, and you're sticking 63.5 of that into a retirement account every single year, the last person you need to listen to is me, because you're already there. Simple as that, all right? You're in good hands. Okay, now finally, the Roth 401k, everyone, because tax is going up. You cannot have a SEP IRA and add a Roth 401k to it, against the law. You first got to have the 401k before you can add a Roth 401k to it. And then everyone, the amounts you can put in on an after-tax basis to grow tax-free for the rest of your life are just incredible. All right. Now, one more time, don't forget that email I showed you earlier at the start of this. The defined benefit plan, everybody, is the big dog compared to these things. I mean, so you see numbers like 32,000, 39.5, and 57,000. In a defined benefit plan, those numbers could be left to right, 80 to 100, 100 to 150, 150 to 200. I mean, you got to really be making some serious money to go with a defined benefit plan. But I know for a fact there are people on this webinar that are doing that right now, and good for you. That's all I got to say. Okay, in starting to wrap this up, everybody, let's talk about these government stimulus payments that you've received in the EIDL grants and the PPP. And not everybody got these things. I hope a lot of you did. Dale Carlton and I spoke for a number of free webinars for CRS, RRC, trying to help you since April 1st with these things. And we have one scheduled. I want you to put this down, everyone. Dale and I are doing a webinar to finish this up on the last of the forgiveness information on December the 18th. And I presume it's going to be 1 o'clock in the afternoon, Central Time. So look in the orange, okay? And then look in the gray. The orange, everyone, was the economic injury disaster loans and the grants that came from the SBA. The gray, everybody, the payroll protection plan came from your local lender, all right? So here we go specifically. So the first thing that Dale and I would have taught you is to go after your $1,000 to $10,000 economic injury disaster grant, all right? And most of you that are sole operators, everybody, would have gotten your $1,000 if you listened to Dale and I. You went to SBA.gov, you filled out 3 pages of documents, everyone, and then you waited, and then you waited, and then you waited. And about 45 days later, all of a sudden, a direct deposit goes to your checking or savings account called EIDL. So you've got that anywhere from $1,000 to $10,000. Then about 45 days after that, you got another email from SBA saying, hey, you are pre-qualified for a loan anywhere from $16,000 up to $150,000. My email said I was eligible for a $150,000 SBA loan. Now, this is not a grant. This is not forgivable. This is a real loan. And look at the next bullet. Non-forgivable, amortized over 30 years, at 3.75% interest rate. Not-for-profits got a 2.75. First payment deferred for 12 months. No prepayment penalty. You could pay it off anytime you wanted to. Now, I declined mine, everyone. I declined mine, but a lot of people took it for this reason. You may be having a bang up year right now, but nobody in this room, nobody on this webinar knows what next year looks like. And that has nothing to do with politics, everyone. But there's a lot of people saying that this next round of COVID is going to be worse and could have further economic ramifications. And I'm just praying, all right, I want you all to do the same thing, that the vaccination results of the last week, everyone, are going to turn the corner on this. And I'll guarantee you this, I'll be one of the first in line after they give the first responders their shots, everybody. I'll get my shot, no ifs, ands, or buts. All right, so then what happened? So I'm going to take you back. You got your EIDL grant and or you got your EIDL loan from SBA.gov. Well, then everybody came the Paycheck Protection Plan, the Payroll Protection Plan, which is called PPP. And there's all the requirements and all that good stuff. And you've already got it, all right? So now, if you've got it, we've got to talk about forgiveness. So look at these 3 bullets, if you would. PPP forgiveness. And Dale and I will be tearing into this hard on December 18th. The next phase, Joanna, this is for you. The next phase of the PPP loan process will depend on whether Congress can enact another stimulus bill, which could happen before the election, and that did not happen, after the election now, or maybe not at all right? As it stands as of the date of this webinar, all PPP loan recipients have to file an application for forgiveness, either on Form 3508, which I call the full-blown form, the 3508EZ, which is a lot simpler form, and then the streamlined 3508S, everybody, which is a blessing, all right? Most of you will need to have your accountant help you do whichever one of those 3 forms, but the S is the easiest of the 3. Now, what's my recommendation? I already had questions on this before I even started. My suggestion is wait another month. Give it, say, 12, 15 of 20 to see what happens in Congress. And if nothing happens on another stimulus bill, talk to your accountant about the application form 3508S, which I'm going to cover in just a minute. Now, let me set you all at ease. Everyone, I've got over 1,000 hours studying PPP, teaching this thing since April 1st. I'm not an expert in anything, but I'm a specialist in PPP, all right? Don't let anybody tell you otherwise, but you have 10 months from the end of your covered period to apply for forgiveness of your PPP loan. Now, your covered period, everyone, would have been either an 8-week covered period starting with the date you got your money from the PPP fund deposited your account, or 24 weeks from the day you got that money deposited into your account. And everybody, 24 weeks from April, May, June of this year is real close to November and December of 2020. So literally nobody has to do anything, everyone. There's no knee-jerking this whatsoever. You got another 10 months from around now to apply for your forgiveness, and that's all there is to it. Now, I wanted to get this behind me because I like to teach this and tell them how it works. So everybody, I did my 3508S on October 15th, gave it to my bank. My bank said, looks good. They uploaded it to the SBA portal, everyone. And by the way, the dates, the bank has 60 days to look at it from the day you get it to the day they get it. Let me say that again. The bank has 60 days to look at it from the day they get it before they have to upload it to the SBA portal. Then the SBA has 90 days to review that application, and they don't have that time, everybody. They don't have the number of people to do it. So my application was given to my bank on October 15th. They uploaded it to the portal of the SBA on the 22nd. And on November the 2nd of 2020, my bank was notified by SBA that my $16,667 PPP loan was totally forgiven. And the only amount I still owed was my $1,000 EIDL grant. So if you got the EIDL grant and the PPP loan, everybody, you're going to have to give back the EIDL grant sooner or later. Trust me, don't argue with me. That's what's going to happen. Already witnessed it. All right. Now, one more thing before I go through the forms and kind of wrap this up. I want to talk about the 3508S. And I want just about 5 more minutes and then I'll take questions. IRS has ruled, everybody, back in May of 2020 in Notice 2020-32 that any business expenses you paid with PPP loans that is then forgiven by the SBA, that those expenses will not be deductible. Well, let me tell you what, I don't think this is going to stick. The HEROES Act in the House of Representatives and the HEALS Act in the Senate, everybody, which still need to be reconciled. They still need to be reconciled, right, for the next stimulus bill. Both those bills have elimination of 2020-32 in the language. So what am I telling you? I feel very confident in telling you at the end of the day, you will be able to deduct the expenses you paid with your PPP loans, even after the loans have been forgiven. So that's my bet. All right. So everybody, here's the brand new form real quickly, and then I want to wrap this up. The form 3508S stands for Streamline. This is a brand new form. There's no calculations shown on it. It's for PPP loans of $50,000 or less. So the person who got $50,001 is going to wish they didn't get that extra dollar. All right. But this form is so easy, it's not even funny. Only for PPP loans of $50,000 or less. This is going to be the form that most realtors are going to use, everybody, especially all of you solo realtors. And I've already talked to several of you before we even started the call, and your loans were under the 50 grand. You can use the 3508S. All right. And you can avoid some of the more complex calculations that go with the 3508EZ and the 3508. Now, here is the top of page 3508S. All right. Nothing to it. I talked to your accountant about how to fill it out. The 3508EZ is more complex, but not as easy as the 3508S and not as tough as the worst one, everybody, the full-blown 3508. And if you got to do this one, it's going to cost thousands of dollars to your accountant to figure this one out for you. And I hope you don't, and I doubt you would. So there we are, everybody. One last thing before my question slide. When you talk to your accountant about the PPP forgiveness, I want you to tell them that you want to elect the 24-week covered period, not the 8-week covered period, because if you elect the 24-week period, I can assure you that all your PPP loan amount will be forgiven. And you know, you can never say always or never to anything, and I would tell you this. If you also got unemployment from the state of Hawaii, and the $600 pandemic unemployment assistance from the federal government on top of your state unemployment. Maybe the 24-week period is not the way to go. Maybe you'll want to go with the 8-week covered period. And Dale and I will be talking about that at length on December 18th. But in the meantime, you're sure welcome to get a hold of your accountant, everybody, and discuss this with them. And I hope they can answer it, although a lot of accountants don't really like this discussion at all. So everybody, before I take any questions, I just want to say this, right? I want to wish all of you, because I know a lot of you won't stick around for the questions. I want to wish all of you a blessed and happy holiday season. Everybody, Thanksgiving, Christmas, Hanukkah, right down the line. Just enjoy it. Enjoy your lives. We are going to get through this. I'm eternally optimistic, everyone. We are going to get through this. I refuse to be holed up like a clam during this. I am doing some live seminars. I'm on the road next week, all week, socially distanced in hotels, and I really don't feel vulnerable at all. But again, I wish you all only the best, and I hope to see you in future years. Crystal, I give you back the floor.
Thank you. Let's give a big virtual applause for Chris Bird. Hey, I got some questions coming in, and Chris Freeze.
Crystal, if I may say this too, just any 2 or 3 paragraph question, Crystal, ignore it because we just can't go that far.
Okay.
Give me the best short questions, and I can help the most people that way. Go ahead.
Okay. All right. Regarding automobile purchase vs. lease, are deductions the same?
No, they're not. And then what Crystal is asking, leasing versus purchasing, everybody. And for example, you cannot take the big write-off if you lease the heavy SUV or the pickup truck. You got to own it. You can claim the standard mileage rate. If you lease a car, you don't have to own it to claim the standard mileage rate. There's a really cool exception there. But you know, the deductions for leasing are not that bad at all. But most people look to the non-tax reasons to lease a car versus the tax reasons. For example, you're always driving a newer car, all right? Generally, you don't have to worry about repairs and maintenance. Some of the disadvantages are that you always have a car payment, and I don't like that at all. But there are many pros and cons to leasing versus buying, and taxes are just a small part of that. Crystal.
Okay, Joanne Fox asks, do we need to file as a real estate agent professional for next year, sole proprietor with multiple rentals?
Oh, well, here's the deal, and Joanne's been listening to my seminars over the years. You need the real estate professional status, everyone, if you have losses, all right, because that allows you to take those losses. Well, I would hope that by now, those of you that have owned rentals for a period of time, you're no longer worrying about losses, everyone. Now you've got profits, all right? So you don't need the real estate professional rule near as much when you have profits, if at all, as when you needed it when you had losses. So now, Joanne, what I'd be looking for is if you've got multiple properties and they are producing a profit, how do we make those profits eligible for the 20% qualified business income deduction? That's the next question. Crystal.
Okay. I think Elaine Saigusa, she's asking about a deduction about sponsoring a child. I think that's maybe through Compassion International, where you sponsor a child, about the tax deductions on that.
Well, number one, I know very well about that program. Kay and I sponsor 2 Guatemalan children through Compassion International. We just got another letter from them in today's mail. So here's the deal. Everybody, that is clearly a charitable contribution. I can guarantee you that. At the end of every year, they send you a statement, and we always contribute directly, direct debit from one of our credit cards. And I get a statement with 52 times that or 12 times that, whatever it is, per child. But that is a charitable contribution. That is not a sponsorship. So doing that through your business, everybody, still reverts it to your Schedule A as a charitable contribution. It's not, I mean, they may say you're sponsoring a child, all right, but don't take that to that slide I had on sponsoring versus charitable contribution. It's not the same thing. Crystal.
Okay. Diane asks, I have done well this year, but can I still request a loan just for a safety net for next year?
Absolutely. And I assume that you're talking about the SBA full-blown loan, because the EIDL grant program is not open right now. And I'd recommend anybody go to sba.gov to check out the status of the EIDL grant. But when I checked it last week, the EIDL grant was closed down, but the EIDL SBA loan was not. And the answer is yes. All right. I see no reason why any one of you in this room, you don't know how bad this can be, everyone. I mean, for all I know, everyone, the webinar business, people get tired of webinars and won't even go to one of these next year. Who knows? All right. And you could still go get an SBA loan, in my opinion. Yes. Crystal.
Okay. Aquino wants to know, if you made money since COVID, can you still get your PPP forgiven?
Absolutely. And Keno, number one, good to hear from you. And everyone, Keno was the one that picked me up from the hurricane-ridden hotel several years ago. And I tell the story all over the country, Keno, about a beautiful woman is going to pick me up in a Maserati. And I thought that was so cool until she pulls up in a Maserati SUV that just looks like my Toyota RAV4. And I teased her to death over that. All right. And Aquino knows that for sure. And I've seen Aquino a few times since then in various celebrations. I think the last one in Vegas. Now, the question Aquino is asking everybody is really priceless. All right. Some of you may not have applied for PPP loans because you thought you didn't need them. All right. And let me tell you what you did. You literally walked away from government money, everyone. And even though 2020 may be a good year for you, again, you don't know how next year is going to be. So if you have not gone for your PPP loan yet, the program is shut down as of today and has not been open since August the 8th. It'll take another stimulus bill from Congress to open up the PPP program again. Now listen carefully. We may know something by December 18th, all right, when Dale Carl and I do another PPP program. But they may not open it up as generally as they did before. They may target businesses that are really hurting this time, like restaurants and bars and taverns. So I cannot guarantee, Aquino, that's going to be open to realtors next time. But if you've already gotten the PPP and you're having a great year, don't you dare feel bad, all right? Because you don't know how it's going to look next year or the year after. And if you haven't got the PPP loan, realtors, it's going to have to open up again and then be open to a business like real estate, and RRC will keep you informed of that. Crystal.
Okay, Margaret wants to know what PPP expenses are.
They're very specific. The 4 PPP expenses that you can spend the money on are payroll, including owner's compensation replacement, everybody, which is your draw. And we don't have time to make this a PPP seminar or webinar. So I really want you to get on to Dale's and my December 18th, or Crystal, if you can download and play for everybody the previous RRC webinars that Dale and I did on Zoom for Paul Dahl and CRS, that would be worth a wealth of knowledge right there. And we did 2 or 3 of them over the summer. But the expenses that you can use your PPP loan proceeds are payroll, including owner's compensation replacement, your draw. That's number 1. Number 2, business mortgage interest, like interest on your car loan, interest on your real estate building loan that you own. Third is business rents. For example, if you lease a car, everybody, that's rent. Or if you lease your real estate office, that's rent. And finally, business utilities, everyone, which are all the utilities coming into your business, but nothing going out, like trash and sewer. No, but generally things coming in, yes, including your internet, business internet, and your business telephone. So that's a real specific answer, Crystal. Back to you.
Okay. Jason asks, I thought PPP and EIDL, if used for different things, could both be forgiven.
Unfortunately, Jason, I'm here to tell you that you misunderstand it. And let me say it one more time. if the same person or the same entity got both an EIDL and a PPP loan, you will be forgiven. I will almost guarantee you, you'll be forgiven on the PPP loan, but the SBA will tell your bank that you are not forgiven on the EIDL grant. I'm sorry to tell you that, but that is the way it is. Crystal.
Okay. If you, let's see, what about purchasing a normal car, not heavyweight?
Well, if you purchase a normal car, and let's just say you use it 80% for business, 90%, whatever, then you can choose to either write off the standard mileage rate on the business mileage, which is 57.5 cents a mile this year, or you can depreciate it and claim actual expenses, which are depreciation, gas, oil, tires, batteries, insurance, etc. Your choice. And remember, everybody, that they have tripled the amount of the car that you're allowed to depreciate under the new rules of 2018. Crystal.
John wants to know, do you advise those of us with S Corp and over 70 converting from 401k to Roth IRR? You want me to repeat
Well,
that?
that's, yeah, I know, I get the question.
Okay.
The real question, the S corporation doesn't have much to do with it other than they're paying themselves a salary. And they ought to talk to their financial advisor and their accountant, because I do believe that every one of you should be putting some money into Roth IRAs, simply betting on this, everyone. Tax rates now, tax rates down the road. And when you have that kind of tax rate environment, tax rates going up, you have to consider investing some of your tax deferred money into after-tax Roth investments. So that is calculation after calculation, not ever to be done on a webinar like this, but at least, Crystal, to give them the fuel to go talk to their accountant about. Yes.
Okay. For PPP, did you have to write a salary check to yourself? And is it too late now?
Well, and that's really a really good question. So here's the deal. Okay. So I'm an S corporation, everyone. So you have to pay yourself a payroll, all right, to use up that PPP money. So basically, when I submitted my forgiveness, I did not actually send the checks, but I could have. I sent my payroll register and my quarterly payroll tax returns for both the state and the federal to prove that I paid myself that money, and that was fully acceptable. Now, for all of you that are LLCs, everybody, are sole proprietors, and you're not a corporation, what you've got to do is you've got to pay yourself what is called owner's compensation replacement. So let me just give an example of a friend of mine that I helped just this morning with this after Indiana and before Hawaii. He got a PPP loan of a small amount, like $5,300. And his 24-week covered period ends December the 19th. And I told him that he needed to write checks to himself totaling the PPP amount. And in the left-hand corner of the check where the remarks line is, write OCR, stands for Owner's Compensation Replacement. And those checks need to add up to at least the amount of the PPP loan for that whole amount to be forgiven. Now, I believe I'm going overboard on this, everyone, and doing more than has to be done, but I'm just trying to make sure that you will get 100% forgiveness. So do checks need to be written? The answer, in my opinion, is clearly yes. Crystal.
For those of us who bought real estate for retirement, we're discovering that we still have to pay significant taxes on the income after retiring. What is the solution to reduce those taxes?
Well, that's a whole nother financial planning question. But let me tell you what, here is my official answer to this, and that is enjoy it that you're making it. Okay, because let me analyze what that question just meant. And Crystal, I got to tell you, I'm looking at you, Crystal, and you are an airline pilot sitting there with your mic on your mouth and all this good stuff. And you're flying a 747 from the Hawaiian Islands to the mainland right now, smiling from ear to ear. Just that's what you're telling me. All right. Okay. Now, here's the deal. Everyone, Kay and I own a lot of residential rental property, and we have a lot of cash flow every single month, and we pay tax on it. Everybody watch me closely. I'm smiling. Everybody, that's a good position to be in. I want all of you to have a tax problem, right? Because you're making so darn much money. So my advice is enjoy it, all right? And don't let the tax tail wag the dog, and enjoy the fact that you're making money. Now, there's all kinds of highfalutin things you can do. Everyone, gosh, I'd want to spend a couple of hours just talking about some of the ways and the higher level things that you can do to try and minimize that. And I don't personally believe in that. I personally believe in making it, pay your fair share, and get on with it, because a lot of people are not enjoying the same thing. You could, I'm just not enough time, Crystal, to give that question a real fair response other than say enjoy it. Crystal.
I understand. We're almost up to 11:30, so I'm going to take two more questions. And I have a scenario here from Sharon, and she says, I estimated my 2020 Schedule C that was overestimated. I received $3,345 more than I should. In your opinion, will this be forgiven, or should I expect to pay this portion back?
Well, let me give you the full question that Crystal is asking. So everyone, my point, this is about PPP forgiveness, all right? And what happened is some banks did not do their job properly, and they should have estimated your PPP loan based on your profit, everyone, in 19. But what the question is I'm getting right now is it wasn't computed properly, and they estimated above the profit in 2019 by about $3,800, whatever it was. And I'm telling you point blank right here, that amount will not be forgiven. Only the correct amount of the PPP loan that you should have gotten will be forgiven, and they will ask you to pay that $3,800 back when the SBA releases the money to the bank, and then the bank calls you. I can almost guarantee they're going to say, we'd like that $3,800 within 30 days. That'd be my bet. Crystal, one more.
Okay, last question. Can I take the vehicle deduction if I have a loan out on the vehicle?
Absolutely. You don't have to have it paid for. And I tried to say that earlier today. You can very well have a 5 or 6 year loan on that deal, everyone, but you have to be entitled. It's all accounts, all right? And the bank's going to have the collateral for it, but you own it and you owe it, so you can write it off. And everybody, one more time, I've thoroughly enjoyed this. And Leonard, thank you for being a sponsor on this, and any of our other sponsors that I'm not aware of. Crystal, thank you for bringing me in on this.
Thank you, Chris.
90 days ago. Patrick, you too, buddy. And Crystal, congratulations on your marriage to this wonderful man. Of anybody I know, Crystal, you deserve happiness, and I'm so happy for you.
Thank you. Thank you, everybody, and have a wonderful day. Thank you, Chris, and we'll see you next time. Aloha.